It's hard to believe, but just around the corner, come 2026, we are going to see some major changes in how much you're paying in taxes and how much tax may be assessed on the money you leave to your friends, family, and loved ones. Today, I'm going to talk about some key changes right around the corner and some steps you may want to take to keep Uncle Sam off your wealth. Keep it right here. Good day, everybody. Chris Herline here of REAP Financial, host of Retire Ready TV on KXAN. That's News Channel 36 every Wednesday here in Austin. If you like our channel, hit the subscribe button, hit the bell for notifications as I drop new content every Wednesday so that you can stay on top of the latest. Today, I want to talk about how to prepare for the major changes coming to your tax bracket and to the estate tax limit, which means how much tax will be assessed on the money you leave to friends and loved ones. Be sure and stay tuned. You don't want to miss this. Now, we've really enjoyed what I would say are some of the lowest tax brackets the last several years in the history of our country. It's a true point. Tax rates have not been this low in 40 years. And yeah, we still like to complain about taxes. I get it. But these tax rates are set to sunset. Not just your income tax rates year to year, but also the estate tax limits are set to change as well. And so these are things that successful retirees, families that have done a great job of saving, have built a nice portfolio, need to be aware of. So let's talk first about what estate tax limit changes look like. Come 2026, tax rates are going to revert back to where they were around 2017. Which means on average, you'll see your income tax rate go up 2 to 3% on average. Okay, so it's not the end of the world. But what that means is that you're gonna be giving more back. And for those of you working, you will want to make sure that you adjust your withholding on your paychecks. Those of you getting Social Security checks or pension checks, you're going to want to adjust your withholding on that too, so that you don't get to the end of the year and you've underpaid taxes and now we're being surprised with a big tax bill and maybe paying penalties that were unneeded. So be aware of that. The other major thing I want to talk to you about is the idea that the estate tax limits are going to not go up like the tax rates, they're actually going to come down. Now, right now in this country, the estate tax limits are as high as they have ever been. And they're at a level of $13,600,000. So let me explain what this means. You can leave up to $13,600,000 here in 2024 to friends, families, loved ones without an estate tax. An estate tax is what kicks in on anything over that limit. So as you can imagine, a lot of Americans today, they don't have a net worth anywhere near that. So they're not really tuned into that. And one of the things that I challenge you with is don't just consider your net worth and your estate today. What will it be worth 10, 20, 30 years from now, right? Let's assume that your investments are invested correctly. You're doubling your wealth every 10 years. You see where I'm going with this? It can add up quick. So if you're over the $13 million limit under today's law, anything above that is assessed a 40% tax. A 40% tax. Very steep. And that's the estate tax. That's not taxes that may be due from your beneficiaries on the IRAs and the 401ks you leave them. So it's a double tax in that sense. But come 2026, these limits are going to revert back to where they were around 2017. They're going to sunset. And with inflation, adjusted index, we anticipate that the limit's going to go from the 13 million down to maybe around 7 million. That's per person, okay? So if you're married, you have a spouse, it's 7 million per person. Still very generous, but it's nearly cut in half. And this is where it becomes an issue. If you have a net worth today of $2-3 million and you're planning or wanting to leave money to your kids, 10, 20, and 30 years from now, we don't know where estate tax limits will be. But even if they stayed the same, your portfolio could potentially be at a level, at a value that you're crossing over those limits, okay? Now, the thing is that this can increase tax burdens on your heirs. What is this going to do to their tax bracket, when they're inheriting your wealth, when they're in their 50s and 60s, potentially their highest earning years, right? So a significant tax burden is something that you need to be aware of when we talk about these 2026 changes coming. Now, the thing is that we're encouraging people to work with fiduciary advisors. Work with advisors that have qualified estate planning attorneys in their back pocket, people that they collaborate with, because there's opportunity right now to make changes within your estate if it's warranted. And if these changes are made now, even with the sunset coming in 2026, potentially you could be grandfathered into these higher $13 million limits. Now, again, this takes advanced planning with professionals. But again, if your wealth is at a point where you are concerned that it may cross those thresholds, this is where you need to be having a conversation. We literally are a year and a half away as the date of this recording from 2026. And this estate planning, this work isn't something that just happens overnight. It's through many meetings, it's through a lot of process. And so what we foresee is people are going to likely be rushing at the end of 2025. Estate planning attorneys will likely be overwhelmed in many cases. So the sooner you can get on this, the better. So I was talking about a fiduciary advisor. This next video talks about what a fiduciary is and how they legally have to work in your best interest. Click here to watch.